So when you look at all these problems, and you look at the good things that are going on, and you look at the problems that we have to face, you say, how do you invest in this kind of an environment? What do we do? Well, I want to remind you that we've always had problems in this country, and since I've been in business the last 40 to 45 years, we've had 3 terrorist attacks, 27 military campaigns, 5 Republican presidents, 3 Democratic presidents, 6 recessions, 6 worldwide currency problems, 20 major companies going bankrupt, 35 notable natural disasters, oil prices going from 3 to 145 and so forth. So as you can see, this country has always had problems, and the way you invest in that is to invest in assets that benefit from the growth of the economy, which eventually comes. And you can see on this chart here, I've listed all of the different stocks and bonds and all of the different asset classes, and you can see that during this whole period, stocks have gone up 11%. Our company has made 14% over the long term, 8.8% in long-term U.S. Treasury, 7% in business real estate, and down the line. So if you look at what to invest in, you can see that if you buy common stocks at the right price, it is the best investment you could make compared to all other asset classes, even though those asset classes have done good and can even do better if you buy them at the right time. So let's review the asset classes and see where we are. If you look at the long-term bonds, the bond rate has gone down to almost a 60 to 70-year low. So that means that over the long run, if we have more inflation and higher interest rates, those bonds are all going to go down. I can't think of any asset class over the next 10 years that is going to do worse than bonds. And it is for this reason that in our bond funds and in our bond portfolios, we're all in short-term paper so that if the bond market goes down, we'll be able to roll that cash into higher yielding securities, and it'll be also short-term until we really get down to the place it should be. Now let me give you some idea of where bond rates are going to go. Usually bonds sell at 3% over the inflation rate. So if you got an inflation rate of 3%, then your bonds are going to sell about 6%. If you have an inflation rate of 4%, you're going to have bonds at 7 to 9%. And if you have an inflation rate of 7 to 10%, you're going to have bonds at 10 or 13%. Now, I can't predict what it's going to be, but I can tell you the inflation and the interest rates are going to be much higher in the next 10 years. I'm not so sure about the next 2 or 3 years because there's still a lot of slack in the economy, so they probably could be okay for the next couple of years. But I don't want to take that chance in being long-term unless it's just certain portfolios because of the fact that there's so much risk on the downside over the long run. So over the long run, I predict that if you're holding long-term bonds over the next 10 to 12 years, there could be losses as high as 40 to 50%. So that's not an area where we want to be, especially on the long side. We do want to be in the shorter-term bonds that give us the liquidity and give us a return, and as the rates go up, we will reinvest them at higher rates. Now, the next asset class I want to talk about is cash, and many people ask us about this because the market's going up, and we're in about 23% cash, and the reason is that when we buy at the buy point, when it gets at the sell point, we sell it irrespective of whether the market's going up or not. That is the discipline, and if we stick to this discipline, we'll always be able to make good returns, irrespective of what's happened. And I showed you all of the things that happened in the past, and we've always been able to make money over the long term because we use the discipline of buying it right, having the reward to risk in our favor. Now, you say, well, if we're sitting 23% in cash and we're not making any money in the cash, we're not making any money. Well, that's not the way to look at it. The way I look at it and the way we look at it at Century Management is if we're looking at a stock, I started to buy one stock. I don't want to mention it because we're not entirely through with the purchase, and I want everybody to be able to get a fair price. But we've been looking at a stock that was at $215 just 6 months ago, and we were able to buy it at $174 the other day. Now, being in cash allowed us to buy that stock at 174 instead of 215. Now that is a lot better value. No matter what happens, if the stock turns out to be a bad stock and we lose money, we lose about 20% less. But if it goes up, we make 20% more. So the idea of buying stocks and waiting for the opportunity is not that we're not making any money in the cash. The cash is allowing us to buy it cheaper and get us a return, and sometimes you can get that return in a couple of months because the stock goes down, it recovers, and then it's on its way up. So the important thing is that we use cash as a portfolio tool to be able to wait for those opportunities, and they always come. I've been in this business for 45 years. I've never seen a year where there hasn't been some kind of a shakeout where you can't pick up a stock or a couple of stocks or even 10 stocks cheaper than what it was at the top of the market. So we are using the cash to reduce the risk, to be able to buy at lower prices, and then to create the opportunity. Okay, let's move on to the next section, which is the gold section. Now, because of the long-term potential of inflation, we have decided to use gold as an asset class, and we're going to review that with great length. There have been debates about what the price of gold should be for hundreds of years. I started off in the 70s. We were lucky to be able to get in on gold when it was freely traded the first time, August 15, 1971. And so we were able to make a lot of money. That was the first good hit I made as an investment counselor, and we did real well with gold. But gold was at $40. It's a different price today. And the methodology that we used at that time was, I would say it was more luck than methodology, because gold was so depressed you could almost not help make money. But that's not the way the situation is today. You have to buy gold at the right price, or you could have an asset that's not making you any money for a long time. Now, these disagreements have been going on for many years, and here's the reason. Some people feel that gold is money, and some people feel it's just a commodity. And you can debate this, but let me just show you back into the 1836 with Baron Rothschild. He was the Warren Buffett of that era. And he said there's only two people who truly understand the price of gold. One is a director in the Bank of England. The other one is an obscure clerk in the Bank of France. Unfortunately, they disagree. So that has been the problem with gold for hundreds of years. Now, we decided to use the methodology that we use as value investors to put a price on the price of gold, and I think we found a pretty good methodology that will give us a reasonable entry point. Here's what we did. The first thing we did is we know that gold is traded for 40 years, so the market price works out what it is worth at different price. So what we did is we took gold in 1971 and we inflation adjusted and said, okay, if it was $650 in 1982, what is it worth today? So we took the inflation adjusted approach. Then we took the actual cost of producing. We've talked to gold miners, we've talked to people who do the accounting in gold, and we've read all the reports by the Gold Council. And so what we came up with is we know that whatever the cost of producing gold, which is about $1,100 to $1,200, called the marginal cost of gold, that is the actual cost of producing an ounce of gold. So we use that as a methodology. And then we used a relationship between gold and oil, and there's been an amazing relationship between oil and gold that's held for 70 to 80 years. We used gold versus the CRB metals. That's all the commodities, the metals. We used it against home prices, and we used it against the CPI. And the National Bureau of Economics just did a report where they hired commodity traders and economists, and they tried to figure out what a methodology to use for gold, and they used the CPI. They took gold and divided it, or put the CPI and divided by gold and the ratio, and we have included that in our statistics. And here are the results of the statistics. At the peak, using all those relationships, we're coming up with 1,900 to 2,200. The fair value, about what it should be trading on, is about 1,150 to 1,300. The buy point is about 800 to 1,000, and the worst case, as low as we can conceivably see it, is about 600 to 700. So when it gets into the 800 range, you've got a good price to buy. You never want to pay more than $1,150 to $1,300 because that's basically, you just have a flat line. You wouldn't make much money, but it's certainly worth that. Now let me show you on the inflation charts how we did that. This is only one of 6 methodologies. We don't have the time to go through all of them, and you probably wouldn't want to hear all of them anyway, but we'll go through the first one. This, to me, is a very valid methodology. I've done this with many commodities, including oil, and it's a very good way to do it. In 1982, gold was selling at 3.25, and if we inflation adjust it, it's at 7.15. If we do the 285, the inflation adjusted is about 715. So you look at the bottoms and you can see that 300 is about the bottom, and if you inflation adjust it, it's around 650 to 700. That's our worst case. If you look at the midpoint, the fair value, it's around $509. That's that little peak there in 83, and then we ran that down, and that came out to about 1,200. So the midpoint is about 1,200. And then we inflation adjusted to peak in 1980 at 860 and ran it out. It came out to 2555. We took a more reasonable peak in 1980 at 711. It came out about 1900. So you can see the upside is about 1900 to 2500. The downside is about 600 to 700. Buy point of 800 to 1,000. And we've actually started to invest into gold mining stocks, and that is an anticipation of the prices that we expect, and the purchases are based on this model. So now let's look at the next chart, which is the raw commodities, which is inflation. Now, if you wanted to use one guide to figure out how to hedge yourself against inflation, you could use raw commodities, because raw commodities are always going to reflect the depreciation in the dollar and the increase in the commodities. And if you started that in 71, when the dollar was detached from gold, which is the inflationary period, you go up to the peak, it goes up about 5 times. So in the last 40 years, if you would have bought commodities, they would have gone up 5 times your money. So that would have been a good way of protecting against inflation, and we are in fact using that and are starting to buy some of these companies that have low-cost producer in commodity. Now, to remind you again of why stocks go up more than almost any other class, no matter what goes on, I'm going to give you the reasons. The first thing is, if you invested in commodities, it would go up 5 times. But if you invested in stocks, the chart shows that the commodities are on the bottom. They went up 5 times, but stocks went up 15 times. The Dow went from 1,000 to 15,000, while the CRB index went from 100 to 500. So how do you account for the fact that stocks perform so much better than the raw commodities when the raw commodities are really reflecting inflation? That is always a question that I have thought about, and I can give you the answers. One of the reasons is that raw commodities reflect inflation, and stocks reflect the increase in inflation and the human ingenuity, the technology. And that is so great that when you combine commodities, which stocks own, they own inventory, they own real estate, they own plant and equipment. So stocks have commodities in them, but they also have human ingenuity. And this human ingenuity is so great that when you combine it with the capital and the commodities, you have an increase of 3 to 1 over what the commodities did. And just to give you a couple of examples of that, you've all used Apple and used their products. That was started in a garage by 2 men with an idea. They created 80,000 employees, and Apple people are 600,000 worldwide that are connected with the Apple Corporation, not necessarily working with Apple directly, but indirectly working with Apple. So here you have a guy who created $500 billion of wealth out of nothing but an idea, and used the commodities and the capital to create this kind of wealth. And that is the history and story of America. And then you take Jeff Bezos. He employs 88,000 people, probably has hundreds of thousands of people connected with it, created $142 billion of market cap of wealth out of, again, nothing. There's a Latin expression called ex nihilo, out of nothing. It's the only Latin word I know, but it's one of my favorite. Bill Gates, 100,000 people, 290 billion in market cap, and Mary Kay Ash started Mary Kay Cosmetic on a kitchen table, part-time as a mother, 45,000 in people, 3 billion sales. This is the reason why proper investment in stocks always yield a greater return than commodities, even though they are showing, even though commodities have a great return, when you combine it with the human ingenuity, that is where you get your bang for your buck, and that's where you want to do it. But I want to caution you, you have to buy stocks at the right price, because if you buy them at the wrong price, just like in the technology bubble, it could go against you and you could lose money. So it's not a guarantee that you're going to, even if you use the best vehicle, that you're going to make money. It's got to be bought in the right price. And I want to give you a couple of examples of that. This is an overvalued market. This is where I started in the business. And this market didn't go anywhere for 16 years because of the fact that it was so overvalued. Now look what happened. During that time, I've drawn a value zone, and if you would have bought stocks in the value zone, and when we started in '74, we did, you can make a lot of money. There were 7 or 8 trading opportunities, 30% each, in a market that really went nowhere. So if you buy the individual stocks, even in an overvalued market, you can make money over the long run if you stick to the discipline by buying in the value zone. Now I'm going to give you another example of a terrible thing that happened. It was one of the worst things that happened to America. It was the bombing of Pearl Harbor in December 7th. Can you imagine anything worse than losing a big part of your fleet, getting dragged into World War II that you weren't prepared for, and having all the dislocations of a major attacks like that? And look what happened to the stock market. The stock market was so cheap that even with this catastrophic event, it dropped 18%, and during the whole war, during the whole 5-year war, even a term when it didn't look like America was doing too well, that market continued to go up and went up an average of 14%. And what is the answer to that? If that would have been an overvalued market, it would have dropped 50%, it would have been down for years. But because it was so cheap, people could buy in there despite all of the problems, and they still made a lot of money.